Welcome back to the deep dive. Today we are taking a necessary detour, I think,
Yeah.
away from the high-level strategy for a bit. We're diving deep into the raw mechanics of calculating your investment gain or loss.
Yeah, it's something everyone thinks they know, right? Buy low, sell high.
Exactly. But when that moment of sale actually comes, it's the accounting, the nitty-gritty that determines your real outcome. And honestly, getting this right can be the difference between a smooth transaction and, well, a nasty tax surprise next April.
It really is the essential arithmetic behind all investing. If you boil it right down, your total gain or loss is simply the amount realized from the sale, minus the adjusted basis of whatever you sold. Positive number. Gain, negative, loss.
Simple formula, but the inputs can get really complex, can't they?
Oh, definitely.
So our mission today is to make those inputs, those complex bits, understandable. We're looking at sources covering everything from like old school debt rules to brand new digital assets.
Yeah.
We really need to nail down what amount realized means, especially with debt. That seems to be where the numbers can get surprising.
Shocking, sometimes. Yeah. Then we'll switch over to the basis side. That means figuring out the cost for tricky things like crypto or mutual funds, where you bought shares at all different times and prices.
Right. And then finally, we need to talk about the exceptions. Those situations where you might realize a huge gain, technically, but specific rules mean you don't actually have to recognize it or pay tax on it right away.
Exactly. Postponing the tax.
Okay, let's start at the beginning then. The first part of that formula, figuring out exactly how much you actually got, the amount realized.
Right.
Okay, let's unpack this amount realized. I mean, intuitively, you'd think it's just the cash you get, right?
That's what most people think initially, yeah.
Yeah.
But our sources are really clear. If you only count the cash in your hand, you're almost certainly going to underreport your proceeds.
Almost guaranteed. Why is that?
Well, the calculation is designed to capture the total economic benefit you got from getting rid of the asset. So the amount realized includes the money, obviously, plus the fair market value, or FMV, of any property or services you got as part of the deal.
Okay, FFV, you mentioned that. Just to be super clear, what are we talking about with fair market value?
Yeah, good question. We're talking about the price that property would actually change hands for, between a buyer and seller who both want to make the deal. Neither is forced, and both kind of know what's going on. It keeps the value objective, even if you somehow got paid in, I don't know, boots or something instead of cash.
Goats, right. Got it. Okay, but then you also subtract selling expenses, things like commissions or fees.
Absolutely. You back out those direct selling costs, broker fees, redemption charges, stuff like that, before you land on the final amount realized figure. But here's the really big one, the thing that honestly makes people jump when they first see it on a tax calculation. Debt. Any debt against the property or even your own personal debt that the buyer takes over or pays off for you, that has to be included in your amount realized.
Whoa, hang on. I have to stop you there. Why? If the buyer just pays off my loan directly, I never saw that cash. How is that part of my proceeds? That feels wrong somehow.
I get why it feels wrong, but think about it like this. The tax authorities view getting out from under a debt, that relief of liability, as being economically the same as getting cash. So if you owe, say, $10,000 on a property, and the buyer pays that $10,000 straight to the bank for you, well, you're $10,000 better off, aren't you? You don't have that liability anymore. It's an economic benefit to you, even if the money didn't physically pass through your hands.
Okay. Frame that way, it makes a bit more sense. And our sources really stress this applies even if the loan is non-recourse, right? Where I, the seller, wasn't even personally on the hook for the debt.
Exactly. Even if you weren't personally liable, the debt was tied to the asset. When the asset goes, the associated liability effectively transfers to the buyer, or at least your obligation ends. That relief is treated as proceeds to you. Look at this example we pulled. Let's say you sell some stock. Your adjusted basis, what it cost you, was $6,000, but you'd pledged it for an $8,000 bank loan.
Okay, so basis $6K, loan $8, and then the buyer pays off that $8,000 loan and also gives me $20,000 in cash.
Perfect. So your amount realized isn't just the $20,000 cash. No, it's the $20,000 plus the $8,000 debt the buyer paid off. That's $28,000 total. Now subtract your $6,000 basis, and your taxable gain is a whopping $22,000.
Wow. Not the $14,000 I might have thought. 20K cash, 6K basis.
Exactly. If you only looked at the cash, you'd be off by $8,000. That debt inclusion is absolutely critical. It's phantom income, in a way.
That really drives home the point about amount realized. Okay, quick technical thing before we move on. What if it's not all cash? What if the buyer gives me like an IOU, a debt instrument?
Yeah.
They promise to pay over time.
Uh-huh. If the buyer issues a debt instrument, the amount realized is usually pegged to the issue price of that instrument. And there's one more kind of niche point, but important if you're the one financing the sale for the buyer. If the debt note you received doesn't have adequate stated interest, well, the IRS makes you treat a portion of the payments as unstated interest. That part is ordinary income, not capital gain. And that interest portion actually reduces the amount realized from the sale itself.
So it's a way to stop people from disguising interest income as lower taxed capital gains.
Precisely. It adds a layer, but it's there for a reason.
All right, so we've seen how debt acts like phantom cash on the realized side. Now, let's flip to the other side of the equation, adjusted basis. This is where the complexity can be baked right into the asset itself, isn't it?
Absolutely. And it's especially true for some of these, modern high-frequency assets like digital currencies.
Crypto?
Oh, yeah, crypto. What's the deal there?
Well, if you're trading digital assets, the tax rules basically demand almost military-grade record keeping. It's intense because the basis is key, and it can fluctuate wildly. You actually need 5 specific pieces of information for every single time you sell or get rid of a digital asset.
5 data points for every trade. That sounds like a potential nightmare if you're an active trader. Is there any wiggle room, or is that really the standard? That is the standard. And honestly, not having that documentation is what causes huge headaches later. You absolutely must record 1, the type of digital asset. 2, the exact date and time of the transaction. 3, the number of units. 4, the fair market value at the time of the transaction and specifically measured in US dollars. And 5, the basis of the asset you sold.
Measured in US dollars. That FMV point seems crucial, especially if you got the crypto as a payment for work.
Exactly. You basically have to prove, down to the minute sometimes, what the dollar value was for every bit of crypto that came in and every bit that went out.
Okay, that's a lot. Now, what about a different kind of complexity? Mutual funds. You don't have that instant FMV issue maybe, but you often buy shares at lots of different times and prices.
These layers of basis
That's
work.
the classic mutual fund problem, yeah. A layered basis. But the good news here is you usually get a choice in how you assign the cost basis when you sell.
And that choice matters because it can really affect your taxable gain for the year. So assuming I haven't already locked into using average basis, what are my main options? Okay, 3 main ways. First, the most precise, but also the most work, is specific share identification. This lets you pinpoint exactly which lot of shares you want to sell. Maybe you sell the ones you paid the most for to minimize your gain. Or maybe the ones you've held longest to get that long-term capital gains rate.
But you have to be really on top of it.
Oh, yeah. You have to tell your broker at the time of the sale which specific shares you're selling. And crucially, you need to get written confirmation back from them pretty quickly. It's definitely for the meticulous types.
Okay. If I can't manage that level of detail or I just forget, what's the default method?
The default, the one you get pushed into, is FIFO. First in, first out. It just assumes the shares you sold were the very first ones you ever bought, the oldest ones.
And if I've been investing for a long time, those oldest shares probably have the lowest cost basis.
Usually, yeah. Which means using FIFO often maximizes your taxable capital gain. Not always what you want. Most investors try to avoid defaulting into FIFO if they can.
Which naturally leads us to the third option, the one a lot of people like for its simplicity. The average basis method.
Oh, right. Average basis. This is available for identical shares, like in a mutual fund or a regulated investment company, or sometimes in a DRP, a dividend reinvestment plan, as long as they're held by a custodian. It makes the calculation much easier. You just figure out the total adjusted basis of all the shares you own in that fund and divide by the total number of shares. Boom, average cost per share.
Okay, let's use that simple example from the source. If I paid, say, $4,800 in total for 300 identical shares over the years, my average basis is just $16 per share, $4,800, $300. So if I sell 150 shares, my basis for that sale is simply 150 times $16, which is $2,400. That seems way easier than tracking like 15 different purchase dates and costs.
It is simpler for calculating the cost, absolutely. But, and this is a really critical point, often missed, kind of a deep dive strategy thing, even if you use the simple average basis method to figure out the cost, you still have to use the FIFO rule to determine the holding period.
Wait, what? So the IRS doesn't let me use an average holding period too? I still have to track the date?
Nope, no average holding period allowed. For figuring out if your gain or loss is short-term taxed higher, like regular income, or long-term taxed at those lower, preferential rates, the shares you sold, are still legally considered to be the ones you acquired first. The FIFO rule applies for holding period, even with average cost basis.
Huh. So I could sell, say, 150 shares using that $16 average basis.
Uh-huh.
But the first 100 of those shares sold might be treated as long-term gain because they represent the oldest lots I bought years ago, even if I bought the other 50 shares just last month.
That's exactly right.
Wow. So that choice of basis method really impacts the tax rate I end up paying, not just the amount of gain.
Precisely. It's a strategic trade-off. Specific share ID, if you can handle the paperwork, gives you maximum control. You can try to match long-term holding periods with high basis shares to minimize tax. Average basis buys you convenience on the cost calculation, but you lose control over matching specific lots, and you're still stuck with FIFO for the holding period.
Good to know. There's always a catch, isn't there?
Usually, yeah. Especially the taxes.
Okay, that whole discussion on basis really clarifies the first part, calculating the gain realized. But now, especially for this last section, we need to draw a really clear line between realized gain and recognized gain. What's the difference and why is it so important here?
It's a huge difference, and yeah, fundamental for this next part. Realized gain is just the math we've been doing. Amount realized minus adjusted basis. It's the profit you actually made on paper, or in reality. Recognized gain, on the other hand, is the amount of that realized gain that you actually have to report on your tax return I pay tax on in the current year.
Ah, okay. So these non-taxable exchanges we're about to talk about.
Yeah.
These are those situations where you might realize a gain, but the law says, okay, you don't have to recognize it or pay tax on it just yet.
Exactly right. You get to defer or postpone recognizing that gain often until you sell the new property you received in the exchange. The classic example here, the big one, is the like-kind exchange, or LKE. Section 31 exchange, people might know it as.
All right, 1031. But that's changed recently, hasn't it?
It has. Big change with the Tax Cuts and Jobs Act. LKEs used to apply to a wider range of business assets. Now, they apply exclusively to trades of business or investment real property for other business or investment real property of a like kind.
So no more like-kind exchanges for equipment or vehicles or patents or crypto.
Nope. Strictly real estate held for business or investment now. Personal property is out. Intangibles are out.
Okay, so we're talking land, buildings, rental properties, stuff like that. And even within real estate, there are still strict rules, right? Like kind doesn't mean identical.
Correct. Like kind for real estate is actually pretty broad. An apartment building for a vacant lot or a farm for an office building, those can be like kind if both are held for investment or business use. But there are sharp limits. One big one is geographic. Real property here in the U.S. is not considered like kind to real property outside the U.S. That swap wouldn't qualify.
And then there are those really tight deadlines for deferred exchanges, where you don't swap directly but sell one property and then buy another.
Ah, yes. The infamous 45-day and 180-day rules. Super strict. You have to formally identify, in writing, the potential replacement property or properties within 45 days after you transfer your original property.
Only 45 days. That's not long.
Not at all. And then you must actually receive the replacement property by the earlier of two dates. Either 180 days after you transfer the original property or are the due date of your tax return for that year, including any extensions.
And if you miss either of those deadlines by even one day,
the whole exchange blows up. The entire gain you realized becomes taxable immediately in the year you sold the first property.
no wiggle room.
Ouch. Okay. Now, what if the exchange isn't perfectly equal? What if I trade my building for their building, but mine is worth more, so they throw in some cash or maybe a truck? Right, that happens all the time. That extra cash or non-like kind property like the truck is called boot. If you receive boot, the exchange becomes partly non-taxable. You still defer gain on the like kind part, but you do have to recognize gain up to the amount of the boot you received. So if you got $10,000 cash and a truck worth $5,000, that's $15 boot, you'd recognize your realized gain, but only up to a maximum of $15,000.
So you pay tax on the boot, essentially.
Up to the amount of your total realized gain, yes. And one more crucial point. If you actually realize a loss on a like-kind exchange, you can never deduct that loss, even if there's boot involved. LKEs only defer gains. They don't allow loss recognition.
Okay, got it. Now, shifting away from real estate, what about corporate stocks? Are there similar non-taxable exchange rules there?
Yes, there are several common situations involving stock where trades or reorganizations don't trigger an immediate recognized gain or loss. Probably the most frequent are corporate reorganizations. Think mergers, acquisitions, spin-offs, recapitalizations. For instance, if company KP1 merges into company KP2 and you swap your KP1 shares for new KP2 shares as part of that deal, you generally don't recognize gain or loss right then.
Or like that example, if RGB Corporation spins off its subsidiary, SFH Corporation, and I, as an RGB shareholder, receive shares of the new SFH company. No immediate tax.
Correct. No immediate tax usually. But what happens is your original basis in the RGB stock has to be allocated between your old RGB shares and your new SFH shares.
Ah, so the basis gets split. How do I know how to split it?
The company doing the spin-off, RGB in this case, is typically required to provide shareholders with that allocation information. It's crucial you keep that documentation.
Makes sense. What other stock transactions are non-taxable?
Simpler ones within the same corporation, exchanging common stock for other common stock in the same company, or preferred stock for other preferred stock in the same company, those are generally non-taxable.
And convertible securities, like bonds that can convert into stock.
Generally, no gain or loss when you convert bonds into stock or preferred stock into common stock. If it's within the same corporation and you're just exercising a conversion privilege that was part of the original security, your basis just carries over from the bond or preferred stock to the new common stock.
Okay. And one last one mentioned, transferring property to a corporation you control, like starting new business.
Right. This is Section 351, another important one. If you transfer property, could be cash, equipment, whatever, to a corporation solely in exchange for its stock. And immediately after that transfer, you, and maybe others transferring property at the same time, own at least 80% of the voting power and 80% of all other classes of stock. Then you typically don't recognize any gain or loss on the property you transferred. Your basis in the property just becomes your basis in the stock you receive. It helps facilitate setting up new corporate ventures without immediate tax hits.
Okay, wow. We covered a lot of ground there, really digging into the mechanics of gain and loss. We went from the core formula, amount realized minus adjusted basis, all the way through to these specialized exceptions like kind exchanges and corporate reorgs.
Yeah, it's a journey from basic math to some pretty complex rules.
For me, the big takeaways really are understanding those structural definitions, realizing that debt counts as phantom cash in the amount realized calculation.
Definitely. That surprises a lot of people.
And then the really strict documentation you need for things like digital assets. That 5-point list is serious.
It is. No getting around it if you want to be compliant.
And also just that crucial difference between realizing a gain, the actual profit, and recognizing it for tax purposes, which is what those non-taxable exchange rules are all about.
Absolutely. And underpinning all of this, every single part we discussed, is one absolutely non-negotiable thing: record keeping. You just have to keep good records. For crypto, like we said, document every transaction, purchase, receipt, sale, the FMV in dollars, especially if you got it as income. For stocks and mutual funds, keep all those confirmation statements from your broker. Keep any documents about basis adjustments, like from spin-offs or mergers. You need to hold on to that stuff until the statute of limitations runs out for that tax year, which is usually 3 years after you filed the return or its due date.
That paperwork, it really is your shield against future problems or unexpected tax bills down the road.
It's your proof. It's your defense. Couldn't agree more. So, maybe here's a final thought, a challenge for you, the listener, to chew on based on our talk today. If you hold mutual funds and you've been using the average basis method because, well, it's easier, remember what we said about the holding period. You still have to use FIFO, first in, first out, to determine if your gain is short-term or long-term. So the challenge is, are you sure that using average basis is actually giving you the best tax outcome? Is it letting you capture those lower long-term capital gains rates effectively? Or are you maybe paying a higher tax rate just for administrative convenience?
That's a great point. Is convenience costing you actual tax dollars because of that holding period rule? Something definitely worth digging into your own records for.
Exactly. Time to check those acquisition dates.
Really actionable advice. Thanks again for taking this deep dive with us.